Gold just hit all-time highs of $2,000 per ounce. And the last time gold made its all-time highs, this was back in 2011. So what has gold been up to in the past 9 or 10 years? So gold's actually been sitting around $1,100 to $1,400 from 2012 or late 2012 all the way up to 2019. And in 2020, we saw gold break back up to new all-time highs of $2,000. And my prediction is gold is going to continue rising, especially with the pandemic that's happening over the world, where countries are printing money left and right, as well as the uncertainty of the US election right now is going to cause gold prices to go even higher. For this reason, I've been looking at different gold companies out there to put my money into as a hedge against all the uncertainty that's happening in the market, as well as I believe gold is going to continue to rise and sit above $2,000 in the future. So right now, buying gold stocks is not just a hedge against what's going to happen in the future, it's also a sector that I believe will continue to grow in the next 3 to 5 years, no matter what happens in the near term. Welcome back to The Fire Grind. My name is Daniel, and on this channel, we talk about personal finance and stock market investing. And in today's video, we have a special guest here called Serafino Iacono, and he's actually the CEO of Caldas Gold, as well as the executive chairman of Gran Columbia. So I had the chance to ask him a few questions of my own as to why he is bullish on gold. So getting an opinion of someone who's been in the industry for about 40 years is a great way for me as an investor who hasn't had as much exposure to gold to learn more about the industry. My typical investments are in technology stocks as well as dividend stocks. So for me, branching out into gold is a little bit new. However, with gold prices rising to $2,000 and possibly rising even further than that, this is what intrigued me into branching out my portfolio into gold. Because logically, when I think about it, for a gold producer to actually produce gold, their costs won't change too much year over year. It might change if some of the materials or just labor goes up, but that change won't be as dramatic as gold rising from $1,400 all the way to $2,000 per ounce, which is roughly a 33% increase. For this reason, I'm looking at gold companies because I believe their bottom line profits will increase significantly with the price of gold reaching $2,000 per ounce and possibly going even higher. This video will be a little bit longer than my typical videos because of the interview style that I'm doing here. And I've left timestamps down below to let you know what kind of questions I'll be asking Serafino. So if you want to skip to the ones that you're interested in, check out the description. First, I'll give a little bit of an introduction into what Caldas Gold is and what's so exciting about this investment. And then next we'll dive right into the interview. And finally, I'll close off this video with my thoughts and what I plan to do going forward. So Caldas Gold is a new listing on the TSX Venture. It trades under the ticker symbol CGC. And if you're interested for Gran Columbia Gold is traded on the TSX with a ticker symbol GCM. So for those of you who are using Wealthsimple Trade, you can find Gran Columbia Gold on Wealthsimple Trade. However, Caldas Gold is not yet listed there. So if you want to buy Caldas Gold, you're going to have to go to a brokerage like Questrade. Caldas Gold, although it's a new listing on the TSX Venture, is an already producing mining operation. They produce roughly around 25,000 ounces of gold each year. So if you multiply that with the price of gold right now, it's producing roughly around $50 million in gross revenue. And right now, the all-in cost for an ounce of gold is roughly around $1,000 per ounce. So Caldas Gold, if the price of gold is sitting around $2,000, is pretty much earning $1,000 per ounce. According to some future projections listed up by the company, they're expecting to produce 50,000 ounces of gold in 2021. So if the price of gold stays around $2,000 per ounce, then in 2021, they'll roughly be pulling in $100 million in gross revenue. And right now, the market cap of Caldas Gold is somewhere around $200 million as of filming today. So the current PS ratio for this company is roughly 4, and the future PS ratio is 2. And in my mind, for a company like this, that is fairly cheap for the amount of growth that we're seeing in the company. And management has even rolled out predictions in the future as far as 2023, and they're expecting to produce roughly around 200,000 ounces of gold. And 200 ounces of gold equates to roughly $400 million in gross revenue. Another thing that you should know about Caldas Gold is that they're actually a Gran Columbia spinoff, which is why Serafino, the CEO of Caldas Gold, is also the executive chairman of Gran Columbia. So these two companies have some cross-pollination, and Caldas Gold is not a new player on the block. They have experienced management from Gran Columbia running the operations at Caldas Gold as well, which ultimately reduces the risk of this new listing. Also, Wheaton Previous Metals recently invested around $110 million into Caldas Gold. And for those of you guys who are new to the gold industry, Wheaton Precious Metals is one of the top gold producers out there. They have a market cap of $31 billion, which is larger than Kirkland Lake Gold, which a lot of you guys have probably seen videos on. So the fact that Caldas Gold, being a spin-off from Gran Columbia, got the attention of Wheaton Precious Metals to invest in them, this operation to me is no gamble. There's definitely some big players that are putting serious cash into Caldas Gold, so this is what gets me so excited about Caldas Gold as a potential investment. Now let's turn our attention to the interview that I had with Serafino. The first question that I asked Serafino is that why did Gran Columbia spin off Caldas Gold if Caldas Gold is such a big deal that it got attention from Wheaton Precious Metals?
The reason that we spinned it off, it's very simple. The company, this was an asset that was hidden and overshadowed by one of our producing mines that produces right now close to 220,000 ounces of gold a year. This produces 25,000 ounces of gold a year. Great asset, great potential, very large reserve and resources, but it was overshadowed by the rest of the inside a package that nobody was paying attention, and we were getting zero value from it. And on top of that, Gran Columbia is a company that it took us 6 years to take it from $1,000 gold into being a profitable company, making great money, great return on investments. And we started with $150 million in debt, and we managed to reduce that debt in less than $40 million. And within the next year and a half, the $40 million is going to be gone. It's a company that's got a fantastic balance sheet. It's got almost $90 million US in the bank. It makes great money every month. It's got very little debt ratio to thing. So we didn't want to go back and develop a second project that was going to cost $275 million and take that and put it back and put debt back of $275 million in the company. A lot of the shareholders that own Gran Columbia didn't want that. What was the best thing that we could do? Spin it off into a new vehicle. Number one, we realized value for something that has zero value in our portfolio and made value. We created $220 million in value, or $240 million as of today in value in the company. So that is a great achievement on its own. We mitigated the debt to be just a project debt in the company. And Gran Columbia ended up, although it financed part of the deal to spin it off, Gran Columbia still owns 57% of the company. So it's a majority shareholders of the company. It's still running, it's still consolidating. I raised all the money. $250 million was raised in the last 4 months to take the project to full production from 25,000 to 190,000 by 2023. So therefore, we achieved, by giving little dilution to Gran Columbia, zero responsibility in Gran Columbia, to have a project that it's totally financed.
One thing that I noticed when I did some research on Gran Columbia as well as Caldas Gold is that Gran Columbia's market cap is roughly $400 million, and Caldas Gold has a market cap of roughly $200 million. However, Gran Columbia produces 200,000 ounces of gold per year, and Caldas Gold is only producing 25,000 ounces per year. So why is Caldas Gold worth so much compared to Gran Columbia based off of these production numbers? And this was Serafino's answer.
No, I tell you what the problem is. There is a disconnect so far in the market, and I think the market is catching up. Gran Columbia should be a company that should be trading at 6 to 12 times, earnings. So Gran Columbia should be a company that should be at $10, $12. That's why you have analysts that are saying that the stock should be $12, $13 a share. The market still hasn't caught up to the value of Gran Columbia. It's starting to. We changed our demographics of investors that we used to have in our portfolio. There was a lot of retail and very few institutional. We're starting to switch now to a lot of institutional that are looking for value. So we went, if you would have looked at Gran Columbia 2 years ago, Gran Columbia traded at $3 a share. Today, Gran Columbia is almost $6.50, $7. Caldas is a different story because Caldas is brand new. People are looking at it as a development project. Gran Columbia is a producing asset. Right now, it's 50% of our asset. And the craziest thing that if you want to look at it, so far, the $130 million in value, $120 million in value that we have in Gran Columbia of Caldas Gold, it's still not reflected in the price and the value of Gran Columbia. So Gran Columbia's got $300 million between cash and assets. And we have a $400 million market cap. There is a disconnect between the market, and we produce 230 million, 230,000 ounces of gold this year, where our cost is all in with everything, with the kitchen sink, $1,000 an ounce. It's actually 900, but I put everything, paying interest and stuff, 1,000. We're making $900 an ounce. That's $220 million US in EBITDA. So if you take a company that's got $220 million in EBITDA, plus it has $300 million in assets, and $40 million in debt, you look at this thing and you say, it makes no sense that you have the value that you have. So what is their only way to go for us to go? The only way that we can go is up. We're not going to go down. And that's why, and we implemented a dividend that is almost a 1% dividend to earnings. And this is going to be a great producer of income, steady income. At least it makes 1%. It beats the bonds. Bonds are making 0%. Okay? And you get your upside on the gold.
Next, we discuss the bullish case as to why investors should take a look at Caldas Gold.
But you look at Caldas. Caldas is also one of these things. Just think about this. This company this year is going to do 27,000 ounces of gold, 27,000 ounces. We're going to close the year, even with the COVID. We make about 900, more or less the same, $900 an ounce. So you're talking about $22 million in EBITDA in this little company. Okay, that's more money than a lot of companies that have right now $500-600 million market cap. Next year, we're going to go close to 50,000, 40-some thousand ounces, close to 50,000 ounces a year. If gold stays at this level, that's going to be $50 million EBITDA. And by 2023, we're going to be at 170, 180,000 ounces of gold a year. That's going to give us about close to $300 million in EBITDA. So look at these numbers, not 300, sorry. It's about, if you take, it's about 190, $200 million EBITDA. But still, it's got a 20-year mine life. It's got a cost of production of less than $900 an ounce, all in sustainable. It's a business. It's based. It will make money even with gold less than $1,400. We put a $1,400 on our bond, but the feasibility of this project is done with $1,300 gold. And at $1,300 gold, that means that we're going to go to a full cycle of gold, and we're going to go back that gold, that the United States is going to be fantastic again. Interest rates will be at 7%. The debt is going to go down to zero in the United States. The whole world is going to sing Kumbaya, and everybody's going to be happy. And then gold is going to go back to its normal levels or to the levels that it's been for a long time. You still would have a company that would create value for their shareholders for the next 20, 30 years.
Now we know the bullish case for Caldas Gold, let's talk production. So is Caldas Gold going to be able to reduce the production price per ounce? And if so, how are they planning to do this?
Yeah. The biggest equation is always efficiency in a company. A company doesn't make money by using inflation or by using, depreciation of currency. Mm-hmm. Our most important thing is that we have a very efficient way of producing an ounce of gold. We produce an ounce of gold at the mine. For me to take out an ounce of gold at the mine and produce it, it's about $700 an ounce. But in the $700 an ounce, then you have to put G&A, you have to put taxes, you have to put royalty, you have to put, local taxes, you have to put what you do for your social programs. And by the time you put all these little items that make life real, then you go into the $850 an ounce. That's your true cost of putting everything. And then comes the reality of things. In a project uh, uh, like like us in Segovia, we produce really at $900 an ounce. Okay, so those are the acceptable cost of producing an ounce of gold. Now, there are very few projects that produce at less than that. There is always projects that produce at 500, 400, but it's always the combination of where you are, location, what kind of inflation, what kind of currency devaluation, and so on. What's the cost of electricity.
Now, I mentioned in the beginning of this video that Caldas Gold has production projections for 2023 of 200,000 ounces per year. This is an eightfold increase from where they are today. So I asked Serafino, how is this possible?
Well, we're building an additional mine. Right now, we have a plant that processes 1,500 tons a day. Okay, and we mine a vein system. These are two mines, one mine on top of the other. The mine on the top, it's always going to produce for the next 15 years, 20 years, it's going to produce 50,000 ounces. It's narrow veins, 4 to 5 grams, efficient, very, very good mining methods. And so we're going to be leaving that for 20 years, 15, 20 years at 50,000 ounces. Below this mine, there is a new porphyry discovery where we have about another 5 million ounces of gold in the reserves, measure indicated category. The lower part, it's a porphyry deposit that's going to be mined in a very different way than the vein. The vein is being mined by cut and fill. You take out a meter and a half vein. Down below, we're going to be taking out chambers. It's called sub-level stoping. So we take out chambers of 50 by 50 by 20 meters, blocks, right? And all of this material that we take out, it's got an average of about 3 grams, 4 grams per ton, but it's all mineralized. So it's bulk, and we're going to be processing this in a new mine, and that's why we raised the $275 million, is to build a new facility and build a new mine below that's going to be processing 4,000 tons a day of material. And out of the 4,000 tons a day, you're going to be producing the differential, which is about 130 to 150,000 ounces additional.
So Randy Smallwood, who's the CEO of Wheaton Precious Metals, is considered to be one of the best steel evaluators in the world. So how has his company gotten involved in Caldas Gold?
Well, Wheaton is one of the companies that I was telling you that if you want to play it safe, they're a royalty company. They're a streaming company. They buy into projects like us, and they get a piece of the gold that is produced for the money that they lend you. Very smart thing to do as a company. They got very few employees. They don't have any risk. Randy got involved with us. We've known him for many, many years. Their company is probably one of the top 10 companies right now in gold in the world. And they saw that we have a world-class deposit with a tremendous upside, besides the gold that we already have, because the deposit that we have, it's still open, and it's going to grow through the years. It's going to grow many, many, many more ounces than where we are. So they bet on our deposit. They know that the risk is mitigated. It's very little risk on us producing the gold that we're saying that we're producing. And what they did is they came in and they financed a portion of the development of the mine. So basically, they put 110 million US dollars into the company. We, as a company, raised $50 million additional on a private placement that was done by Scotia and Canaccord. And then we did a bond. And the bond that we did is an instrument that it's actually a very smart instrument for people that want to play gold. Instead of playing it through Wheaton, it's sort of like another way for you to play gold. Because what we did is we did a bond that pays you a 7.5% coupon. It's a 6-year bond. It pays you interest for the first year. After the first year, it'll pay you principal and interest. So it's a 6-year bond. It pays you a 7.5% coupon. It gives you a floor of $1,400 an ounce. Okay, so anything, if gold goes to below 1,400, I'm guaranteeing you that you're getting paid with a $1,400 value. Okay, so if I have to produce more gold, I'll produce more gold and I'll pay it. But anything above the 1,400 gold goes to the bondholder. So it's a kicker for the bondholder that when you put it with the value of the 7.5, it gives you a return of about 11, 12% a year. And we take gold, we pay the bond on a monthly basis, the interest, on a quarterly basis, the principal, and on a quarterly basis, you receive the kicker of the gold that is produced because every month we put our gold away and it gets put aside. Plus, you get a warrant that if you put all three together as an equation, you will have almost a 15, 16% return on the thing, on the bond. We placed close to $90 million on that bond, and it's sold in 2 days. Because you tell me, where are you going to get a return on investment of that? Guaranteed by gold, they're guaranteed by 6 million ounces of gold. I have over there, they're all investments that are through Gran Columbia. For example, Goldex is a 6 million ounce in resources in Guyana with a project ready to be built. Also, companies like Wheaton have streaming on that thing, ready to write a check for $150 million in that company. So it's a decision-making company. Either we're going to sell it to somebody that wants to buy 6 million ounces of gold, or we're going to build it next year ourselves. And then Gran Columbia owns 20% and 30% on a fully diluted basis of this company. So it's a great investment. We invested $10 million in this company that today is worth $50 million. We have Western Atlas, that is a little company in Canada, but it's a little company right next to a monster of a company that is like Nico Eagle, with the extension of the deposit that produces 1 million ounces of gold, 1 million plus ounces of gold. So we own 19.9% of that company. So we have a toehold in that company, and we have an opportunity to make that company grow. Same thing with Caldas. Caldas, we have now 57%. We basically own the company. We're the largest shareholder. But in that company, in Caldas, we have a project that it's called the Juby, which is part of the pipeline that's got 3 million ounces of gold, and it's going to be an exciting project in Ontario to be developed after we finish develop Marmato. That's going to be the next project that's going to be developed. We have a mine that it's JV with IM Gold, that it's a silver gold polymetallic mine that we're going to see what we're going to do with it, and it's going to be the next mine that we're going to be paying attention and we're going to develop. So we got a portfolio pipeline that make us not a one asset company, but it makes us a multi-assets growth company that eventually they'll grow and they'll become something bigger. That's what makes big companies like a Yamana or something. It was the combination of putting together a lot of projects and develop those projects.
Next, we dove into some of the economics of gold mining and what it is fundamentally. Okay.
Look at it as a earth-moving operation. Any kind of mining that you're going to be looking at, you got to look at it as an earth-moving operation. Whether you move dirt, you move rocks, or you move gold. If we take an average of 3 grams per ton, that we're taking of a ton of material, 1,000 kilos of material, I am moving $170 worth of material. So for me to make an ounce of gold, which is 32, I have to move 10 tons of that material. For every 10 tons of the material, I get 1 ounce of gold. And that's the mathematics. And no matter what material you move, and the question is, and the equation is very simple. What does it cost me for me to move 10 tons of that material that is worth $1,900? What does it cost me to process that material? What taxes do I have? And that gives you the economics if a project is economic or not. It's as simple as that. And that applies for gold, for silver, for rocks, for coal, and everything else that you produce in the world. It's an earth-moving operation. That's all we are.
You guys know that when I look at a company, I often look at management to get some idea of who's running the company. Likewise, for Caldas Gold, I asked Serafino, what is the management team like at Caldas Gold, and what is the cross-pollination between Gran Columbia and Caldas Gold?
There is cross-management at 4 levels. On the corporate level in Canada, the CFO is the same CFO. The president of the company is my CEO in Gran Columbia. And the reason that I have him, because he's a hands-on guy that builds mine and operates mine. That's what he does. And then myself, other management. There is a cross-pollination, if you want to call it, of directors of the company, because they're very valuable people. People like that you have on the list, Miguel de la Campa, Hernan Martinez, that was an ex-minister of mines of Colombia, and all the other, and a couple of other directors that to us are key to have on the Colombian equation. All of our directors are valuable on both companies, but these directors, they're very close involved in what happens in Colombia. So we have that cross, but anything in Caldas below the president, CEO, and CFO is a completely separate team, geological team that does the geology, the people that are going to be running the mine, that they're going to be building the mine, that they're going to be operating the mine. We have a COO that we're bringing from one of the very large Australian operation that's going to be joining us next month. And he's going to be the project manager that's going to take this project to completion by 2023.
So we've heard a bit about Caldas Gold's projections and how much gold they can produce in the future. But another thing that I asked Serafino is that, are there any more exploration opportunities with Caldas Gold in their current mining sites?
Huge. I mean, right now we have 6 million ounces of gold in the reserve, measured and indicated. The deposit is still open. It's in the first 400 meters of a face of a mountain that goes down 1,200 meters. Then below that, you have the Cauca River, so you got a plain, but you're still 1,000 meters before you reach sea level. So this thing's got 2,000 meters, 2 kilometers, from top to bottom, still open. It's got at least 1,000 meters still open at depth, and it's got. We have a strike length right now of about 700, 800 meters strike length by a true width of about 300 meter in an envelope of another 500 meters of 2-gram material that eventually, when I explain to you that it's an earth-moving operation, once you have the right price of gold, that 2 grams becomes part of the envelope to be mined. It becomes economic. It's all about how economic can you mine it. But we have a very, very big deposit. It's still open to the east, it's open to the north, and it's open at depth. In my opinion, this 10 years from now, it's going to be double the amount that we are right now, and still growing.
Not only is the experience of management important, also is management currently a shareholder in Caldas Gold?
I'm not only an employee of this company, I am also one of the largest shareholders of this company. I put my money in this company. I keep on putting my money in this company. So my my ideas or my goals are the same aligned as the shareholders. So
Yep.
we have the same alignment, shareholders and myself. The idea is to grow this company and to make money. Shareholders make money, I make money. Shareholders lose money, I lose money. So that's the biggest incentive. I'm not just an employee that makes a salary, and that makes the big difference.
Now we turn over to Gran Columbia to get an idea of how Serafino ran Gran Columbia. So the first question that I asked about Gran Columbia is that how did Gran Columbia find so much success recently?
Segovia was easy because Segovia has been around as a mine for 100 years. It's got 100 years of history. It's a district. It's not only a mine. It's a very particular concession. We, our shareholders and myself as Gran Columbia shareholders, are not the owners of a concession that it's owned by the Colombian government. We are the owners of the land and the mineral rights. And we basically, as long as we produce 1 ounce of gold, we own the title. It's called a crown title. So it's a very particular title. It was very challenging for us to take it because it was a concession or it was a mine that was in the hands of the Colombian government for many, many years, since the 1970s. And it was badly run. It was bureaucratic, had too many employees. It was losing money. They were stealing gold, all the things that happen when you don't have an owner of a company. When I took it over, it was producing 60,000 ounces of gold, but still, it was 60,000 ounces of gold. And it was losing money. It wasn't making money. It was losing a lot of money. We took it from the operation, and through being diligent and being methodical about turning it around, we managed to take this thing from where it was, every year increase the reserves, every year lower the cost of operations, every year optimizing the workforce, and every year increasing the production until we reached the optimal, and which is the 220,000 ounces that we produced last year. Now, you also got to have some luck. And we had very much luck because from the price of gold being $1,000 an ounce, we managed to bring costs down, but also the price of gold started rising up. And that has helped us in becoming an incredibly profitable company. And we are a very profitable company.
Throughout the interview so far, Serafino seemed to indicate that Gran Columbia was undervalued. And if you guys also watch Daniel Pronk, he's one of my favorite Canadian YouTubers. He was discussing 3 mid-cap gold stocks, and Gran Columbia was one of them. And he mentioned that Gran Columbia was severely undervalued compared to the other 2 stocks, KRR and USA. So I asked Serafino, why is Gran Columbia so undervalued right now?
We have gone through a transition, and there is only in the last year and a half, 2 years, people are starting to realize the true value of this company. This company had a legacy, unfortunately, of being a company that was a producer when prices of gold were so low that nobody was making money on gold, except maybe the majors. So we managed to survive. But again, we became unfavorable to a lot of investors because at one point in our life we had a lot of debt, we had a lot of we weren't making that much money on the production of gold, so that stuck around into the head of some institutional investors, and they haven't done their homework, or they hadn't done their homework to see that we are a completely different company. And it's our job also with people like you to tell the story and to make everybody realize that the company is a completely different company. This company 6 years ago was a company that was maybe producing $3 million in excess cash flow. This year, we did $90 million in excess cash flow after paying everything. So it's a completely different monster. It's starting to catch up, and eventually the stock will catch up with us. The analysts are the smartest ones that are looking at this thing, and they see that we are the company that probably has the best value for you to come in, you know. And the most important thing, the quants, the people that do analysis are the people that are looking at this thing, and they look at the key things. Is he making money? How much money is he making? Am I creating value for shareholders thing? Those are the guys that are starting to buy our stock that before weren't looking at our stock.
As the interview was coming to a close, I asked Serafino which investor is suited for Gran Columbia and which investor is suited for Caldas Gold.
Gran Columbia, Gran Columbia is, if you want to look at a project that is diversified in different areas, in different countries, and it's got a pipeline of projects in different countries. Gran Columbia is a country that produces gold in Colombia, has a toehold in a company that will produce gold in Guyana. We got Canada, we got diversification as a project. We are a dividend-paying company. It's a much more advanced company, and it's still got a long way to go to become a very, you know, a full value company. It's got a long way to go. Caldas is a brand new company. It trades not even as an exploration company. So it's a company that you want to come in. You want to buy something that it's long term. If you want to buy Gran Columbia, you own Caldas through Gran Columbia, plus you own a lot of projects. You want to be a project-oriented company, that it's a company that grows and it's going to become a major producer, that eventually a Caldas might be taken over by a major company and it becomes somebody else's company. That's the company to come in, and you coming in very cheap, because at $3 a share that we trade, $2.95, $3 a share, if you compare it to companies right now with producing company, you pay $150 an ounce, okay, in the ground. You're paying $40 an ounce. So you're paying 1/3 of the value of what you would be paying for an ounce in another company that is getting close to produce. But we're producing. That's the big thing. And we're fully financed. So it's two different shareholders. Look, I believe in baskets of opportunities. It's not only Gran Columbia or Caldas. The way I invest in our business, in our sector, I invest in a basket of companies. So I buy Gran Columbia, I buy Caldas, I buy Western Atlas, I own Goldex, I own K92, I own shares in companies. I take a position because it's a basket for an investor. It's a basket of company. Maybe this one will not do that well, one will not do that well, but one of those companies will do great and one will do absolutely exceptional, fantastic, like a Fosterville that goes up, 10,000%. But there is very few companies that go up 10,000%. The real companies in life will go up on fundamentals. We have created a portfolio company that we run that are based on fundamentals and real numbers, not on speculation. You want to have some speculation too, because it's the lottery.
And this interview concluded with a question about mining in Canada. So for those of you who live in Canada, you know that wages in Canada are a lot higher than other countries like South America. So I was wondering, how do mines in Canada keep their costs low to be competitive in the global gold market? Because an ounce of gold mined in Canada is the same as an ounce of gold mined in Gran Columbia.
Some of the mines that we have, for example, in Segovia, are semi-mechanized mine. For example, the cost of producing an ounce in Marmato, lower mine, it's going to be a fully mechanized mine. It's going to be less labor. So in Canada, you will put together a mine that is mostly mechanized or fully mechanized. So your cost is going to be in your CapEx more than the OpEx, because you're going to have less personnel. In this day and age, mining is becoming a completely different thing. And you that are in the business that you understand that better than anybody else. We are working already with projects where trucks in open pit mining are mechanized and robotized mines where the trucks operate on their own. They don't have a driver anymore. So that means that you don't have to have three drivers on three shifts. Same thing as in the underground mine. I was telling you before that I went to see a company in Italy that designs for robotics for factories. We were talking to them to see if we can put certain things that make more efficient. Instead of having a machine that needs an operator after to take the material after you do the explosion, or if you have, when you do the drilling inside the mine, you have a robot that does the drilling, that puts the dynamite, and when you does the explosion, it doesn't have to wait 5 hours before the air clears to bring people. Without humans, it becomes more efficient. Maybe it's more expensive on the OPEX, but it's less expensive on, on the CAPEX, but it's less expensive on the OPEX because you don't have the personnel. The mining of the future is going to be done by robots. That's the reality. And that's where the world is going to go. So it's going to be young people like you that is going to be there with a joystick in Toronto, sitting around, managing a machine 1,000 kilometers away underground and taking material out. That's where the world is going. So in the future world that we're going to have guys that are going to be, operators, engineers, guys that the guys that understands programming computers, and the running of a mine. Maybe not 5 years or 10 years, but I'm telling you, in the next 20 years, that's the way you're going to be mining. You're already seeing mining operation where the trucks don't have people that drive them. You have robots that manage cleanup. You have all sorts of things that do survey, that they, instead of having a person that goes underground into a mine, you have a robot that does a better job than a human being because it can scan and look at the defects and look at where the weaknesses are and understand the world. This is going to be the world.
After going through this interview with Serafino, I personally learned a lot about gold and am more bullish on gold going forward in the future. And currently I have a very small position in Gran Columbia, which I opened up after watching Daniel Pronk's video, seeing how undervalued Gran Columbia is. And going forward, I do plan to do more research into Caldas Gold, as I'm more of a high-risk, high-reward investor. So I may open up a position in Caldas Gold, because if this mine does take off, like Serafino and management predicts, then I think we could see major stock price appreciation in Caldas Gold. So putting maybe a couple $100 into Caldas Gold in my Questrade account is probably what I'm aiming for in the next couple of weeks. But I will be looking into the financials a bit more and may release a video on that. If you want to see that video, let me know in the comments down below and I can do a bit of a deeper dive on this company if you're interested. As always, smash the like button as well as subscribe and hit the notification bell if you're new to the channel here. And keep up the grind and have a great day.